All right. Good afternoon, everyone. This is Joe Pacella here at Chaikin Analytics, and welcome to our open forum webinar for today, Monday, April 24th. We are going to take a specific focus on how you can analyze the condition of different indices and sectors within Chaikin. All of this is going to focus on having ETFs within our program. So we're going to use ETFs that focus on sectors and indices throughout our session. If you have any questions throughout, make sure to go ahead and chat in at any point using the Q&A room. You should be able to find that in the upper left-hand corner of your screen. You can ask questions about really along any kind of line. I'm going to stick with the habit of focusing on topics or focus on questions involving our main topic, which I'm sure there's going to be plenty of questions about today. I do have a lot of different functionality to show you, so I'm hoping that a lot of you come away with a new perspective on how to use Chaikin, how it can benefit you. Something that's important to keep in mind is that I've been getting a lot of questions lately about earnings. Obviously, we're still kind of going through earnings season, and there's implications for a lot of different investors. I think what's important to note as we go throughout today's session is that there's a lot of different types of investors and traders who use Chaikin Analytics. So keep in mind, if you hear about a strategy, a thought process that is applicable for, or doesn't sound as relevant for what you're doing, that's perfectly okay. The main focus, and it's a little bit of a challenge when you have a couple hundred people on an open forum like this, but the important thing is to not lose sight of what your interest in the market is. You know, if you're using Chaikin Analytics to buy and hold, keep that focused. I don't think there's any reason to change it. If you're using Chaikin Analytics to swing trade with options, that's perfectly great. The important thing to just kind of keep in mind is that we can cater to a lot of different strategies, not just those two, even though they kind of summarize most of them. So just kind of keep that in mind. Everything that you see on today's webinar may or may not be appropriate for you, but at least it'll give you a little bit of different insight on the market, and hopefully turn out to be a benefit for you in one way or another. So, all right, with that said, joining me in a few moments will be John Schlitz, our Chief Market Strategist. John's going to provide a nice overview, especially in light of a great day in the market like we saw today. And of course, sticking around with us is Michelle Greenblatt to answer all the questions, or not all the questions, but a lot of the questions that come through. So you can check out a recording of the session. We're going to post a recording tomorrow morning. Just make your way right to the resource center here, and you will find a lot of great support content here, including the link that will take you to where you can sign up for the other sessions taking place this week. Onboard session, we are switching over the schedule to Monday, Wednesday, Friday. Just keep that in mind. So if you do like to check those out, just to stay in the loop about what's new with our program, just keep in mind we're going to be shifting to a Monday, Wednesday, Friday schedule. Pre-market and options remain the same, Tuesdays and Thursdays at 8:30 and 11 o'clock Eastern time. You can attend live or just simply check out the recordings right here, which is where the open forum recording will be. So, all right, let's get into the content. So a great way to start out a demonstration of indices and sectors is to provide an overview for the market. So John, whenever you're ready, take it away.
Okay, thanks, Joe. You can hear me okay?
Mm-hmm. Sounds good.
All right. Good afternoon, everyone. As you know, we've been writing for a few weeks now that the market was acting more, to us anyway, like it was looking for an excuse to go up rather than down, despite the fact that every decent one-day gain we've seen over the past 6 weeks had quickly stalled out. And we felt that way because, and we still do feel that way, because leadership was still pretty good in the rebound phases of this consolidation, and because small and mid-cap indexes were beginning to outperform over the last few weeks. It was also because just about every negative that developed over the past few weeks, whether it be plunging oil prices, underperforming bank stocks, moving average violations by the Dow and the S&P, a surge in the VIX, or continued stubborn weakness in yields, none of that could generate a lasting sell-off in equities. The frequency of strong individual up days also started to increase, with 2, as you know, occurring just last week. And that forced us to continue giving the benefit of doubt to the bulls during this consolidation phase. Obviously, admittedly, it was far from a pound the table position, given all the continuing moving parts, whether it be Korea, Syria, the French election, the Fed tax proposals, the healthcare bill, whatever. But nevertheless, just gave us the feel that it wanted to go up. It just needed a reason. Also, the bears had multiple opportunities to build on some pretty aggressive one-day sell-offs of the last 6 weeks, but they also couldn't keep the momentum going. So that was obviously a positive sign. And the net result was a market that was constructively working off the excesses generated by the post-election surge, which is a pretty typical scenario in technical terms. However, bullish investors were obviously and pretty conspicuously sitting on the sidelines waiting for either some clarity, a catalyst, or both, or either one. Obviously, earnings have been better than expected so far, but the French election was a dark cloud hanging over just about every major global equity market, and that threat obviously went away yesterday, which unleashed a surge of sideline cash waiting to be put to work. So today we not only had short covering and the unwinding of a fair amount of put protection, we also had some real buyers, some real intermediate buyers starting to dip their toes in the water again. Having said that, as we mentioned last week, you can't put too much emphasis on any one day, especially when all the other balls are still up in the air. And also when we're dead smack in the middle of earnings. Earnings have obviously been good so far, but we still have to get through 160 S&P companies reporting this week alone. Today also wasn't the first day of the rally. The Russell 2000 was already up 4 out of 5 days coming into today. The transportation average is now up 5 out of 6 days, and while the Dow and the S&P aren't quite as stretched, they still have to deal with resistance from the March highs, which sits directly overhead. So it's not a layup from here just because we had one good day. And it means we'll probably see some short-term profit taking, kind of a sell the news situation either tomorrow or Wednesday, which is perfectly okay. The key is how we react to that stall. As I wrote this morning and just mentioned, so far we've had 4 strong up days in the S&P since setting the highs in March, and each one has subsequently fizzled out. If we can get a solid wave of secondary buying after a brief pause this time around, then the S&P should be done with this particular consolidation phase and be ready to start another advance towards the lower end of our long-standing intermediate target area of about 2450 to 2500. So that's pretty much it for the overview. As far as today's credentials go, obviously they were pretty good, especially for a Monday. Total exchange volume beat the 10-day average by about 12%, which doesn't seem like a lot, but it's very unusual for a Monday when volume normally contracts about 15%. So you have almost a 30% swing there. Volume in the spiders and the triple Qs was also well above the respective 10-day averages, and only 15% of the stocks in the S&P declined, and obviously most of those were defensive stocks, which you want to see decline on a day like today. Good leadership, better than expected earnings, improving economic data, rising earnings estimates, relatively low yields, and strong overseas markets, both in the stock markets and also in terms of their economic data. They are rarely the conditions that you see at a major market top. And for that reason, we're still optimistic for hitting the target area, and therefore would stick with the strategy of continuing to buy oversold pullbacks in stocks in bullish sectors and with bullish power gauge ratings. And I believe Joe's going to show you how to find them on the system and also how to focus in on which ones, those that seem very similar on the surface, focus in on which ones make the most sense. And with that, I'll turn it back to Joe.
All right, awesome. Something that I did during the during John's overview there is a few minutes ago, John was referring to kind of a tussle between bullish and bearish sentiment, and we've kind of seen that intraday sometimes. There's been a couple of days here and there, and it just made me think as one of the good ways to stay on top of the performance throughout each day, of course, is with the intraday chart that's available. All in an effort to show some functionality. I'm not sure if to what extent everybody's using this each day, but something that I think is helpful, especially midday, is just to see where are we in reference to the open. You can see for the market on a day like today, clearly you'll see a nice easy summary right at the top, gap up at the open, and as the illustration suggests, pretty much stayed there all day. This obviously isn't always the case. You're going to find some days where we gap up and then close negative. I believe if I'm not mistaken, Friday was pretty similar to that. A few other days in the past, but as we enter that conversation and really think about, if bears happen to have the opportunity to really get the upper hand, where are they closing in relation to the open? So just a nice little helpful reference point that I'm not sure everybody's aware is here. So with that in mind, today's session is a little bit of a continuation from a webinar that we hosted a few weeks ago. I think it was, excuse me, a little bit more than a month ago. We hosted a webinar on creating user lists and keeping track of broad ETFs. What we did during that session, it was simply enough, is go through the process of creating a new list, but then also using this to stay on top of whatever's trending. Now you might ask, well, so if you're thinking of today almost as part 2 of that session, how did I use this today? Well, pretty straightforward. Just, first thing I do each morning, every Monday morning, is just read through Mark's most recent article. And going through here, I pretty much got the vibe, and it was pretty clear reading through the details that you can expect a pretty positive response following the results of the French election. I didn't highlight specifically where that is, but I'm sure most of you have read this. So in any case, you expect a positive day. And what I'm looking for on a day like today is who's leading, who's going through on a given day. What's kind of taking the baton. And going through the program here, it was pretty helpful just to keep an eye on, for example, financials, regional banks, bank ETFs. Again, these are subsectors that John mentioned during that webinar. I remember he called out the KRE and the KBE specifically at that time. And for those sectors, really, I'm just going to start with financials here because I know there have been so many questions from you all about what do I do about stocks like JP Morgan, like Bank of America. And the story has been, well, pretty much what I've tried to emphasize during a lot of calls is really if there has been pretty much anything in the financial sector has really pulled back lately, but is the cause of that pullback, is it due to the individual stock or is it the sector? Think, for example, Goldman Sachs. Goldman Sachs disappointed with earnings last week, and a lot of it had to do with the fact that it's falling behind a bit. So yes, almost all financials have been doing poorly, but in the case for Goldman, it had to do with itself. Whereas in the case for today, and I think for the case for most financials, you can see how there's been a struggle to get right back up to this long-term trend. And so when we look at stocks like JP Morgan, pull this up, you can see that trend continuing. As the sector goes, so too likely will be the stock. This is a really good example of Mark's phrase, rising tide lifts all boats. And that's, of course, a reference to the market and individual stocks. Well, I think what we've seen throughout 2017, at least so far, is pretty much, as for financials at least, the rising tide lifting all boats can apply just for financials and for banks. So you're seeing a lot of these stocks kind of returning, having a strong day along with the market. So you can apply this thought process not just to individual sectors, but of course but the stocks themselves. I'm going to go back to my panel view here where I can see all of those ETFs that are in my list. I can again, check in, compare where was the leadership on a given day. Now, shifting our attention away from financials, focusing more on a broad index here, small caps have been getting a lot of attention. On our pre-market sessions specifically, I'm just going to pull up the IWM here by double-clicking on it. The excuse me, what we've been saying about small caps is to recognize the decline that it's gone through, but to make sure you have a clear understanding of what it has been going through. So you have the decline, however, you do kind of have a bottoming out. You can see that since about March. So yes, you've been lagging behind the broad market as a whole. However, you have not continued that decline. It's almost as if you've flatlined a bit. And so with our attention on small caps here, you can see them advancing not a great extent beyond the market, but still doing better than the average here. So you can see just by having each of these sectors, the ones that are really kind of driving the market, the ones that are being cited in market insights and having a great impact on the market as a whole, the ease, the speed, the efficiency of being able to go through each one of these groups can put a lot of time back in your day. So having a direction, having an idea for what the market is up to, pretty much what John just said, and you know, you can listen again to his comments by watching the recording tomorrow morning. But with that in mind, going through the commentary from Mark Chaikin, so summarized, so concise and easy to understand, you're getting the sense here that the market overall is holding up pretty well, and the signs of a bear market aren't quite there, or correction or anything. So having that heading in mind, you're able to break down and go into each one of these groups. Now, some ways to get some ideas. The two groups, indices, as well as, of course, our ETFs is where the bulk of your work will be. We do have a few indices listed here in these groups. The Russells used to be here. Now, keep in mind with these indices, they're just simply a list of all the stocks in each one of those groups. What I've done, and you're welcome to write these down, feel free to go ahead and copy these, frankly. These are some of the ETFs that are cited most frequently with being used to track an index. So notice how the NASDAQ, oh, here, the NASDAQ is here. You can simply go ahead and focus on Qs. And when you do that, you'll have that updated here. So I have that in my list. Something else that gets cited pretty frequently in market insights is the RSP, the equal weighted ETF for the S&P 500. Really helps us get an idea for what is driving the market. Is it just the FANG stocks, for example, or are you starting to see some performance from smaller caps? And as the Russell 2000, again, has kind of flatlined, you can see that their performance versus large caps have been improving, and therefore you're seeing that reflected in the overall market. I've noticed for some of these indices from a short-term basis approaching an oversold position. By the way, I saw that there was a question regarding overbought, oversold for us. Using the 30 and 70 parameters, I know is different. I know a lot of people are used to seeing it, the 20-80 parameter for stochastics. We just like having a kind of, because we don't put as much dependency on overbought, oversold for our complete analysis of the market, we're okay with using parameters that are a little loose. But in any case, it's the main focus is on the direction of the stock. And for short-term purposes, yes, you're getting direction, but really for broad analysis, we're focusing primarily on bulls versus bears. So speaking of which, to keep track of those power bars here, something that is always helpful, and it's always a shame if I ever hear that subscribers aren't aware of this, but if you do click on this drop-down menu here, this will give you a quick peek at the condition of the power bar for a given ETF. So I'm going to go back to the SPY, and on a day like today, where the market had a pretty strong day really across the board, especially in financials, you might recall that if you've been on one of our webinars recently, any one that I've done at least, there's been a great amount of emphasis on the fact that for financial stocks, there are a lot of neutral positives. So what exactly does that mean? Bear with me for a moment here. So let's see if I can get this up here. I'm just going to give it a moment to load. XLF. And so for financials, the cause for so many neutral positives is the fact that the sector as a whole has recently dropped below its long-term average. And so as you can imagine, the implication is that a lot of bullish stocks, you may remember from December and January, you were looking at 40, almost 50 bullish stocks in the financial sector alone. Well, with all of them pulling back, and for pretty clear reasons that we know now, again, they're not in as perhaps bad a situation as you can expect. So for last week, there was a pretty good example. So there's been a lot of questions about these neutral positives, and a lot of questions that I've had about financials is that, well, we're starting to see a lot of stocks become neutral positive. Does that mean that that financials are ready to break down? And our contention has been that the answer is not quite. Now, yes, you've clearly had the pullback below the long-term trend. That's pretty obvious here. But performance alone isn't what's going to give you your guidance going forward. I think it's a pretty slippery slope, a pretty easy trap to fall into when your attention is purely on how this sector, how a stock, whatever it might be, has fallen below that point. What I would caution to you not to lose sight of is the great lack of bearish stocks in the sector. What this really represents is more of a likelihood of a shorter term pullback as opposed to a longer term breakdown. And one of the great sectors to compare this against is what you see propping up all of those other sectors, and that's the energy group. So I'm going to pull up the XLE right now, and if you're wondering, well, how can I make the case for a bearish sector then? I would tell you to pay very close attention to energy right now. Because when you look across the board here, bear with me for a moment, you're going to find far more bearish stocks than bulls in this group. When you look at the energy sector, yes, you're below your long-term trend, just like financials. However, pay attention to that trend of money flow. Notice since that point for when the sector dropped below, you've seen a significant trend of negative money flow. You may have also noticed for the XLF how there was a pretty sharp drop off of relative strength. And it's to the point where you're just about breaking even, but you're not nearly to the point where you're severely underperforming the market for pretty much since the end of January. And the main thing going forward is, what is it that gives me that forward guidance? It's not quite as much as the technical charts as it is the overall balance of the power gauge. Way more bearish stocks than bulls. And that is what the great concern here is. So it's a reminder for keeping your eye on what the power gauge rating for individual stocks tells you. As you roll that up into ETFs, again, you're given a little more clarity on what you can expect. And simply enough, this allows you to better position yourself for success. There is a bit of functionality that I think is extremely helpful and, of course, consistent with our theme for today. And what I would recommend is, if you look in the upper right corner, you have your drop down window, and again, I try to demonstrate this as much as I can, but I think for a day like today, where we're talking a lot about different sectors, put into context the performance. Don't just simply write off a day like today as, bullish across the board, which in and of itself is great. That let's not, I don't want to be too picky here, but when you notice financials in great shape, industrials falling behind, technology, materials, so on, rounding out the top four sectors with the market, just also recognize the lesser extent of growth that you see in a group like energy, because that's simply you can see the performance of the market on display. Again, a rising tide, a day like today, does lift all boats, and again, that does include even the weakest sectors. So yes, to see a positive day in energy does make sense. I mean, after all, however, just note the difference in growth between two of these sectors. So that is some of the really that's the main takeaway that we're seeing from a day like today. This unfortunately is becoming, I guess you could say, commonplace. What we've seen for the past few months has been a great difference from how we started out the year. But that really is what we're getting used to before at least the end of earnings season, which we still have a little bit of time left for. I shouldn't say a little bit of time, but we still have plenty of time left there. Mark highlighted the fact that we are focusing on in Congress, the debt ceiling. I guess negotiations might be the right word for that, but in any case, that of course is always going to be contentious and will surely have an impact on the market to a certain extent. But nonetheless, the question of is this market still intact? I think there's plenty of signs to point to that you're still looking at a pretty strong move. So with that said, if you have any questions, now's a really good time to go ahead and get them in. A few takeaways, a few action items. If you have not already, I really cannot implore enough that you take advantage of creating a list within Chaikin Analytics with some of your favorite indices, some of your top indices that you're focusing on, and influence your approach to the market. I haven't spoken much about the Qs, the GDX. If any of you are interested in precious metals, that is an example of something that you can follow closely. The TLT, if you're interested in following the bond market, also something that you can add into a list like this. These are just ones that I follow very closely. Yours may look different, it may look the same, but in any case, I'm sure I would be willing to bet that almost everybody here has an interest in following these closely. So I would recommend creating a list just like this and keep an eye on how they are performing going forward. It's all about ease of access. Provide yourself a friendly little reminder to go through each one of these on a weekly or bi-weekly basis, so that again you're on top of the trend of the market. So any questions, you can access the upper left hand corner of the page, and we'll go ahead and make our way through, and then we'll probably wrap up the afternoon with that. Let's see, we have been talking about financials, and I cited this stock earlier. Harry, just with a quick question, can we take a look at Goldman Sachs? And I feel like I should have done that earlier, so apologies for a little bit of a cliffhanger here. But so for Goldman, obviously came out last week and really disappointed with earnings. And so where do we go from here for a stock like Goldman Sachs? Obviously, today was a welcomed bit of relief, but note how you're even further below your long-term trend than most of the other financials out there. So what does Chaikin Analytics tell us for here? Well, you've had a good couple of days leading up since the days that Goldman reported. And again, like I said, today, luckily not just today alone, where you had some improvement here. I'm assuming that you may be long on Goldman, or your interests may be long here. In any case, you do have an improvement of money flow, which is encouraging. You are down here in an oversold position. Relative strength, again, for a short period of time, you have been underperforming the market. But what is important to note, and what I typically don't pay very close attention to the factors of the power gauge rating, since my attention is typically on the overall rating. But it will be interesting to see how earnings would impact the overall rating for earnings, and therefore the rating for the stock. Again, I think to a large extent, as the sector goes, so will Goldman. But again, that remains to be seen. Let's see. The XLRE. Let's take a look at what's going on in real estate. So real estate, I believe, was that the one group that was down today. Yeah, it looks like it was. So defensive sectors, this along with utilities, the two that were behind on the group. Real estate going forward using Chaikin Analytics, I see a great number of neutrals. Yes, you have 3 bulls and 6 bears, but most of the stocks here are in neutral condition. So I'm inclined to believe that we're probably looking at a good handful of neutral positives, but let's take a look to make sure that that is the case. It's actually not. Interesting. So real estate kind of benefiting from the decline in the market, true to its defensive nature. I will pay close attention to relative strength. If I were to see it in a few weeks or a month or so, where it's down back to the point where it was in March, I wouldn't be surprised, but we will see how that goes. The sector as a whole, overbought position. Money flow kind of holding up where it is. Pretty much in most cases, whenever we're having conversations about real estate stocks, there's a pretty strong interest in dividend. I know they've come up a lot in our screens. Anytime that there's a really sharp improvement, but if pretty much, hopefully, if you have been in the retail sector lately, pay very close attention, of course, to what kind of dividend you're getting and put that in context of the performance here. Let's see. Randy has a question here. Any thoughts on the education stocks moving higher? Education stocks. I can't think of any index I've come across regarding education stocks. So without that, I couldn't tell you. If you do have an ETF that you use to track education stocks, I would more than happy to do it here today. Or if not, you can pull it up in your platform. Let's see. Frank asks, any thoughts on using indexes for put selling indications? Put selling, I can't think of anything off the top of my head. If anybody has a suggestion for Frank, go ahead and just chat that into the Q&A box for put selling indications. Hopefully we'll get a contribution or two. Steve, is there any index following just big box retail and just one for specialty retail? If there was, I can't think of one off the top of my head. However, where would we go? Consumer discretionary, if I'm not mistaken. Trying to find. So I'll start with this. There's the retail ETF. Where is it? Or subsector. So you have the XRT, which is, I know not what you're looking for. It sounds like you're looking for something a little more specific, Steve. But I'm going to start with the XRT, so the retail ETF. Now, you use the term big box. So what I'm going to do is I think you might agree Best Buy might fall into that. Or let me see if it's here. I wonder if Costco is in this list. Here it is. Costco is probably as textbook of a big box example as you can think of. So what I'm going to do here is I'm going to really kind of compound my use of Chaikin Analytics to find one that matches. So I'm just going to go ahead and for Costco, I'm going to click on the magnifying glass here. And I'm just going to go through ETFs. And what I would tell you to do is just go ahead and make your way through each of the ETFs that Costco is in and see if there's any kind of title that matches what you're interested in. Let me see if there's any that I noticed right off the bat here. Multi-factor. You're going to see a lot of market cap based, maybe not sector specific. Momentum, consumer cyclicals, dynamic retail portfolio. They have a lot of dynamic ones. Anyways, I would recommend that you walk through here, see if you can find something that works. And this is one way that perhaps you can lead your way to an ETF that matches what you're interested in. And you can apply this to a lot of other specific sectors as well. Let's see. Can one graphically compare one stock with another? In Chaikin Analytics, unfortunately not. However, you do have the reference to the SPY. So having the SPY here comparison is really consistent with our main goal. You're trying to outperform the market. So we don't have other stocks that you can compare to, but I think that relative strength chart does a lot more work than you may originally realize. So, all right, let's see. There was a comment here, I think a follow-up comment from one of the earlier questions for DV, education stocks, that's right. So DV, he says the leader. So I'm going to apply that exact same process actually. So looking at, obviously it's in great shape. I'd love to find more stocks like it. Other consumer discretionary, okay. So one place you can start, I'm not going to do it here, but go ahead and click on other consumer discretionary. This would take you to other stocks in that group, even though it's a pretty general theme, I guess you could say. But what I'm going to do is I'm going to click on the magnifying glass again, ETX, and I'm going to look for, again, Alpha Dex, interesting. Consumer services, IYC could be one. Consumer sentiment, pure value. Let me see, is there anything? Ultra mid cap. I know it's a pretty specific one, but it is interesting. It sounds like you're gonna, one that you may settle with is the consumer services seems to make the most sense to me right off the bat. Let's see, ACLS. ACLS, just a request for some commentary on ACLS. So yeah, looking at it overall, great bullish power gauge rating, been bullish for a long, long time. So in this case, what does that mean? You know, when I find a stock that's been doing so well and it's still bullish, what does that imply? Well, there's still growth ahead of time, going ahead. So hopefully you've been in ACLS for a while. If you have, you've done well. And if you're still in there, well, Chaikin Analytics is telling me that there's probably still some good times ahead. Relative strength has been excellent, remains excellent. Its money flow, after bottoming out a little bit, really, really improved. So it's in great shape here. You are well above your long-term trend. You're in your upper channel. So there's plenty of good things working for you for ACLS here. And of course, from a short-term perspective, you're in a nice oversold position. So yeah, not a whole lot to be too concerned with here. In fact, pretty good opportunity. It is trading in its upper range and it's oversold, which usually makes people feel a little uncomfortable. But after a pretty strong gap up here, it looks like you've kind of pulled back a bit in true overbought to oversold fashion. And yeah, by all means, it's pretty clear bullish argument to be made. It is a pretty small cap stock. It's only 500 million, but by all means, it seems to be in pretty strong shape. Let's see, getting down the last few ones here. Put selling depends on thesis, doesn't necessarily need to use the index to sell put. If you are doing, if what you are doing is using put selling as a way to get underlying at a better price, you need to work off a chart, a company you are wanting to get. Same thing if you want to get an index. Other than that, I don't really see the point of selling puts of how selling puts makes most sense. Yeah, it's a pretty big discussion to have, but I think again, it's one of those perfect examples how it's not always appropriate for all strategies. We'll wrap up with the last two here, AAOI. I should say, actually, Don mentioned the FXD if you're interested in education. Don pointing out FXD could be one. In the case for AAOI, semiconductors have had a pretty tough 2017 to an extent, but man, what a volatile stock. pretty sharp money flow, kind of pulling out relative strength down there as well. Luckily, you've kind of recovered nicely, or at least, again, well, to an extent, you're on your way there. Reports earnings in a couple of days, or about 2 weeks, a week from Thursday. At least you're in an oversold position. Hopefully that'll launch you up leading up to earnings. Would love to see it improve a little bit more before that point, but this is a pretty volatile stock to be in. Also a small cap. You can see just how much it's dropped within the past month or so. So if you're in here, hopefully you're obviously aware you're in a small cap. You're aware of the nature of small caps. That would be pretty critical. So, all right. And we'll wrap it up there. Check out the recording tomorrow morning. Again, it'll be posted after our pre-market session. Thanks to John. Thanks also, big thank you to Michelle as well for helping out. In the meantime, everybody have a great afternoon. Have a great week, and we will see you tomorrow morning for the pre-market.